Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay, and the story is shifted from large to the mid-caps. So it's been steady for the frontline indices, 22,700 on the Nifty, a gain of about 0.3%, but the mid-cap index, that's where the action is. The mid-cap index is up 0.8% and it's moved to the day's high.
Complete bull charge, that's what it is, right?
Yeah.
And even on large caps, let's not forget that we do have a headline for you. The index has scaled 22,700 on the Nifty, so it's not bad going for even the large cap universe. And today you have participation coming in from banks. Banks have they've been leading this leg of the up move, and that continues even today. So if you look at the bank Nifty, it's actually doing better than the Nifty. But Reliance has started performing now. Last couple of days, that was my constant grouse saying Reliance is underperforming, Reliance is underperforming. That's kind of changed, and right now it's on the top side of the screen. And the other big trend for the day is commodities. Whatever is happening in the commodity markets, that's having a direct bearing on the way stocks are reacting. So, for instance, some of the names like BPCL doing better because there is a bit of a cool off in oil prices. But look at Coal India, look at Hindalco, ONGC. It's really a JSW Steel. It's an out-and-out commodity play, and we will talk a lot more about that as we go forward. But yes, absolutely. I mean, the mid-cap market is definitely stealing the thunder. The index is up about 0.8%. Though if you look at the advanced decline ratio, that's the thing. Today, it's more of the index mid-caps that are doing well. But overall, if you look at the advanced decline ratios, it's pretty much neck to neck in terms of the gainers and the losers. 1,100 stocks advancing and a little over 1,000 stocks on the declining side. But very much a green screen. So let's straight away get to our first market conversation on Trading Hour. Chirag Mehta from Quantum AMC is our guest on the show, and let's get some perspective going with him. Chirag, great to have you on. Thank you so much for joining in. I think investors who are already invested in the market, they are simply smiling, looking at this rally continue, this massive bull charge continue. But the ones who are looking to deploy additional money, they're the ones feeling a little left out, confounded, confused. So at the outset, what are your opening thoughts on what is turning out to be, the breathtaking rally pretty much continuing?
Thank you, Surbhi, for having me on the show. So I think what we are seeing is a continuation of recovery in the economy. The economy looks robust. All the leading indicators look pretty constructive in nature. So I think the rally is here to stay. So we are positive on the economy, and that is what is driving the markets to some extent. There is hope that there could be China stimulus. The growth expectations on the global world are also changing. What was earlier a pessimistic scenario that global world is going to slow down, it's not happening anymore. So in all sense, I think there is support from the global world from a growth standpoint, as well as India is doing very well from a growth perspective. So that tells us that the rally is here to stay, and I think we are pretty constructive. And the levers that have been taking this rally are here is going to be the same levers that we'll see going forward as well, led by capex, government capex. Now we are also seeing green shoots in private capex coming through. Consumption is still slow. We have seen uptick in two-wheeler sales in rural areas, and that is more driven not by new purchases, but our sense is that it is more driven by a replacement demand. If you see the last big cycle that we had in two-wheelers was because of was about 8-10 years back, and now we are seeing more of the replacement demand kick in, telling us that there is recovery in that space as well. So overall, we are very constructive. The capex plays here, which will be the biggest driver, followed by household capex. We are seeing housing activity being very buoyant, which we think will continue and therefore has a cascading effect on the overall economy, right from building materials to other ancillaries and consumer discretionary that come along with it, along with consumer durables. So I think there is a lot more traction going on in the economy, and it's going to be a similar growth trends that we have been seeing, a continuation of that for some more time.
Do you want to share some of your portfolio ideas or recommendations for this capex theme? Because it's been running for the last 2 to 3 years, and most of the stocks have done very well. So it's great if it's already in your portfolio, but for fresh investment to play this capex theme going ahead, which stocks would you recommend?
So I think if you see from a CAPEX standpoint, a lot of it is in the price because, there is demand, there is traction in that sectors, industrials, be it power. So all those, there is a good amount of traction in those sectors. but much of is it in the price. So you need to look at niche areas. For example, when it comes to power, there is a great team going on in, say, smart meters, for example. So you need to look at those kind of niche plays which have not yet fully priced in the order flows and therefore the revenue growth and earnings growth. So probably you could look at those sectors, and within those sectors, you'll have to look at niche plays rather than looking at just frontline plays within those sectors.
Any other niche plays that you would, ask investors to look at, analyze? So smart metering is one. Anything else that you would, you'd like to highlight?
So if you look at even within those sectors, like recycling is a big story that is playing out. You have water-related, waste-related plays, which are looking constructive from a long-term perspective. So you have many things, but you need to look beyond the frontline growth trends. And if you were to look at within the frontline growth trends, it's going to be the usual banking and financial sector or the IT sector is what we like. And in the consumer discretionary, you need to look at themes like, for example, two-wheelers, four-wheelers, where we have a constructive story playing out. And we think that will continue for some more time.
Okay, so that is the CAPEX theme. Tell us about some of your other biggest portfolio overweights. I mean, whether it's BFSI, consumer. Just tell us what your next big bet is beyond CAPEX and how are you looking to play it?
So from a valuation standpoint, we still like banking and financial space pretty much. Valuations are still constructive. There is not much worry from a NPA perspective. There is still growth. Only lingering concern was the deposit growth that we were not seeing in the banking sector. But our sense is that given the franchisee that these many banks have, I think there is some cyclicality to that deposit growth. But beyond that, we think that deposit growth will catch up as we go forward. So there could be some deviation away from, for example, banking and CASA and fixed deposits that we are seeing. But I think into capital markets, etc. But probably over time, I think you will see as incomes increase, there will be space for even some sort of fixed deposit growth or CASA growth, as well as the growth in capital markets. So we like both the themes. From a banking standpoint, banks look very conducive from a valuation standpoint. Whereas in the capital market space, we have seen a good run up already in many of those names. So probably at some correction, we could be looking at buying those further in our portfolios.
About IT, frontline IT is one of the preferred sectors along with banking and I think two-wheelers. Now, in IT, over the last 12 or 18 months, it's been some of these mid-cap IT stocks where the growth rates have been strong, like a Persistent, Coforge, or some of the ER&D plays, like a KPIT Technology, Cyient. These are stocks which have outperformed. Going ahead, should investors continue to bet on the outperformers of the last 1 to 2 years, or is it time to look at the at-scale big services companies to make money?
Sure. I think we like this space across. So in large cap portfolios, we have exposure to the frontline names. In these small cap portfolios, we have these small budding names in the IT sector. So we like the space across the spectrum. What we are seeing is there was some sort of pessimism related to growth trends in this sector. But I think that pessimism was overdone. And we were big buyers when these stocks corrected in the interim, and we continue to like these stocks. We are constructive that outsourcing is here to stay and will only increase going forward. AI trends was one of the other headwind that we were hearing from market experts. But AI, I think Indian tech companies have shown time and again that they kind of catch up with the emerging trends and benefit out of it rather than lose share. So from those perspectives, I think we like this story. I think AI, the biggest beneficiary, will again be Indian IT companies. We are seeing already IT companies shape up their training programs towards AI. So I think we like this space across the board.
Chirag, finally 30 seconds left on the chat. I just want to end with your take on what's happening in the commodities universe and whether you think there's a fundamental reason to play these stocks. I mean, look at the way metals have shot up. Even refiners have done really well for other reasons beyond just the price moves. I mean, the expectation of pretty high margins. Just leave us with your take on oil and gas, on metals, the commodities play.
So our call is that metals and oil probably should trend lower from a price perspective. We think that, currently the news stories around China stimulus growth holding up well in the developed world, etc., has led to this uptick in metals. Probably, I think it's kind of moved beyond what we would have expected. So I think both oil and metal prices should head lower over a period of time as the story kind of fades out. So we think that best of the prices probably are behind us. Probably metal prices have peaked, and therefore we don't see much traction in this sector in a big way, barring some places where we have valuation comfort because of the earnings growth that will kick in many of these, which still look buoyant for a couple of years. So over and above, we are kind of not buying anything in this sector at this point in time.
Right.
And that's what our take is.
Chirag, thank you very much for joining in. Look forward to more such conversations. From equities to commodities, where everything from gold, silver, cocoa, everything's hitting new record highs. Manisha joining in. Manisha.
Well, thank you so much for that. Everything in commodities actually seems to be doing quite well. Energy is the only place where we have seen some profit taking come in today, but that also seems to be inching up on your screens right now. But apart from that, whether it's about precious metals and industrial metals and soft commodities as well, many of these prices continue to run up on the higher side. Take a look at gold prices, and we are trading at around $2,360 an ounce in the international markets there. That's an all-time high. Silver at 28.19 on your screen is a 3-year highs. But for the Indian markets, gold and silver both are trading at an all-time highs. It has been one-way rally in the last 16 or 17 days that we've seen into this space. Well, valuations are higher, as Chirag was pointing out, and perhaps it's overheated as well, but the momentum still on the higher side. Come on to industrial commodities, industrial metals that is, and here as well, everything seems to be trading at a multi-month highs. Zinc, I'll start with that, is trading at a 1-year highs. LME copper, while is trading at a 14-month highs, the Chinese copper prices are trading at an all-time highs. Markets are anticipating, one, they are reacting to, of course, the stronger data that we've seen. Manufacturing activity across globe seems to be picking up, and there are expectations of China coming out with further stimulus measures in sense of property sector that has been supportive. Moving on, when you look at platinum prices, that's trading at a 4-month highs. Tin is trading at a 15-month highs, aluminum prices at a 13-month highs, and this can go on because many of these metal prices are doing quite well. Even iron ore prices from its 10-month lows have moved into 2-week highs as we trade right now. Soft commodities also have been doing quite well. Cocoa prices, for one, have been trading at around all-time highs at $10,000 a ton. I mean, cocoa prices have gained up by 150% in this year alone. Rubber prices trading at a 3-week highs. Coffee prices at an 18-month highs. And I can go on with the list. But most of the fundamentals do look strong. There are supply disruption concerns. And with demand picking up, these are the prices doing quite well on your screens.
Oh, indeed, everything seems to be doing well. Hard commodities, soft commodities, liquid commodities, solid commodities, Manisha. Thank you so much for that, Traps. It's really a huge bull market going on out there. Thanks for joining in. Well, with that, we do have to take a very quick break. Come back on the other side, and it is all eyes on the IT sector as the Q4 earnings season is about to get underway. So we'll be putting the spotlight on the expectations, also what to expect in terms of just commentary. Looking forward to FY25. Kumar Rakesh of BNP Paribas is going to join in for this.
Welcome back. Now, the tech sector is in focus ahead of TCS's fourth quarter numbers on Friday. Now, BNP Paribas, in a recent note, said that the IT industry has possibly bottomed out, and they expect fourth quarter constant currency revenue growth to range between +1% to -1%. To talk about the trends, the outlook, we're now joined by Rakesh Kumar, VP of Equity Research at BNP Paribas, to take some questions. Rakesh, great to have this conversation. This is Rima here. Can you talk about the statement that you've made in your report that IT earnings have bottomed out? And also, the pace of recovery, will it stay at these, middling kind of growth rates for the next few quarters, or will we see a sharper recovery? What are growth numbers looking like for FY15 and FY26? FY25 and 26. Yeah, go ahead.
Got it, Rima. Good morning. Thank you for having me on the show. So the pace of recovery, what we are looking at, even if you are looking at some of the guidance, full year guidance that the companies have given, even at the lower end of it, it implies from where the December quarter YOY growth was, year-over-year growth, we would be looking at recovery across most of the companies into the March quarter. So while there are still concerns on the discretionary demand picking up, at least cyclically, we would start seeing many of these companies to start reporting better year-over-year growth in the March quarter itself. Last quarter commentary also was indicating to some extent that there are some signs of green shoot. As we move into FY25, the base case expectation, at least on the industry growth, would be that it should do at least 2 percentage points higher than where we would be ending in FY24. Within that, some of the IT services companies with much stronger deal wins and better execution will possibly grow stronger than that. But more importantly, within FY25, as we move towards the end of FY25, towards the second half, we expect that the discretionary demand should start picking in, and that could potentially accelerate the overall growth of the industry. As you would have seen over the last 2 years, this discretionary demand was one of the key catalysts to drive the industry growth lower, and specifically in the existing contracts. Not necessarily in the new deal signings, because they have been quite robust actually for the industry overall. It's the existing contracts which were getting reassessed and possibly ramped down, and that was what was impacting the growth. First stage would be that we would start seeing the stabilization on that front, which we believe that has already started playing out. There are no material incremental ramp down in the projects. And as we move into the second half of fiscal 25, we should start seeing some of those projects ramping up, some of the new discretionary projects also coming in, and that can potentially accelerate the growth and should set us well for FY26 to be even stronger growth here.
Rakesh, hi. Thank you very much for joining us on the show. So I want to ask you that, as the IT sector has gone through this post-COVID challenging phase, and now, as you're saying, that we're probably past the worst and the recovery moves forward from here on. In terms of the top tier companies, which are the ones that you think are coming out right on top in terms of weathering the challenging phase the best and taking charge of the AI opportunity? I mean, for instance, Rima's poll for Q4 tells us that TCS is going to lead the charge on top line growth. And TCS has been, one of the better performers. So just tell us, top tier IT, which have become your favorite stocks in terms of how companies have responded to the challenge and how they're willing to now capitalize on the AI opportunity?
Hi, Surbhi. Actually, if you look at these IT services companies over not just last year or so, over the last couple of decades, what they have been really good at essentially is not taking any technology call. Whichever technology comes along, they prepare themselves well to execute and implement projects associated with that. Be it mainframe, be it the era of cloud, and now possibly in the era of Gen AI. So what essentially we are looking at or are trying to gauge these companies is based on how well they are preparing themselves. And you would hear a lot of news flow around the partnerships, getting certification for some of these AI suites and AI products of some of the product companies. So that is where we currently are. These companies are trying to equip themselves with the capability and understanding of these AI products, which they can implement better for the customers. And in that context, historically, we have seen Infosys is one of the company which has done really well, and some of the partnerships which they have formed are quite remarkable, and they definitely seem to be doing a good piece of work over there. TCS also, as you mentioned, in this particular quarter, obviously it appears that they will have a stronger growth, but more importantly, from preparing for the implementation of Gen AI work, they are also working quite smartly. We are a little early in this cycle right now to start assessing who's ahead and who's behind. Possibly in a few quarters, we'll start getting a better sense who's positioned where. Right now, almost everybody is trying to build this capability, which I was referring to. And as we enter into 2025, we would start seeing the effect of this into converting into revenue as well. And that is when we start expecting that there should be an incremental budget allocation for Gen AI projects. And that should translating into some of the companies outperforming because they are stronger in Gen AI and some of the companies underperforming.
Rakesh, which are the companies which are most leveraged to a pickup, a revival in discretionary demand in large caps and in mid caps?
In the large caps, I think a good gauge would be who struggled the most over the last year or two. Infosys has struggled in the recent quarters. LTIMindtree has struggled, but they have a very strong core portfolio of digital capabilities, both of these companies, and they should ideally perform better once the discretionary demand starts picking up. In the mid caps, it becomes very company specific, difficult to call out broadly over there. Most of the companies have far higher exposure to discretionary and digital technologies, but at the same time, they have outperformed because their addressable market expanded and also their execution specific to their client or vertical has been quite strong. So there may not be as big a delta as possibly we would start seeing in some of these companies in the large cap.
So Infosys and LTIMindtree. A quick question then on the CEO changes. Now this quarter, we will hear from Tech Mahindra's CEO Mohit Joshi on the revival turnaround plan. So all eyes are going to be on that, whether there is, he can put the pedal to the metal. And also secondly, on Wipro, the change in guard with Srinivas Palya coming in and Thierry Delaporte out. How would you read these two?
Yeah, even outside of this, over the last year or two, you would see there are a lot of CEOs in the large caps itself who have been there are new CEOs across the board in the larger companies as well. So the industry is now in that churn phase where we have a lot of new CEOs around. Possibly it will increase the competitive intensity overall for the industry. That being said, we do not buy the argument that the company can dramatically get changed within a quarter or two just because a new CEO is there. These IT services companies are like driving a large ship. You cannot turn these ships around within a small period of time. And one of the reason why that is the case is because 97-98% of the revenue that these companies book are from contracts which have been signed in the last 6 months, last 2 years, or possibly last 3 years. And hence turning around these companies in a very short period of time has its own cost. Either it comes along with margin getting diluted, or it comes along with a very lumpy execution or getting into verticals which possibly may not have a sustainable growth in the future. So we'll have to be very careful in how we assess the turnaround story of some of these companies. While we appreciate that there are new CEOs around, there are fundamental reasons of underperformance and outperformance to a specific company, and that does not dramatically get changed within a quarter.
I guess that explains why neither Tech Mahindra nor Wipro are in your top large cap picks. Infosys, HCL, TCS and LTIMindtree are the top picks at BNP Paribas. Just leave us with a call on companies that you're really watching out for in the mid-cap space as well. As you said, it's a lot about capitalizing on those discretionary spends, on those opportunities there and niche technology opportunities. So which ones are you most convinced about at the moment?
We cover persistent systems and we quite like the company. It's a very solid track record of execution. Over the last 3 years, they have pivoted with higher focus towards the services business, and that has worked really well under the new CEO. And it appears to be doing pretty well despite the macroeconomic slowdown. It hasn't dramatically impacted their growth story. And as the demand starts accelerating, we would assume that there is going to be a further acceleration in growth, which is already in mid-teen, and possibly margin expansion as well. So that should translate into a much stronger earnings growth. And hence, while on valuation, it could look expensive, if you start looking at on a PEG ratio, it will fall back into a similar range where the rest of the companies are.
Okay. Thank you very much for joining in. Look forward to more conversations with you to get some insights in the, what's happening in the technology world. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in with his top trading bets. Welcome back. Mitesh is now with us for a quick technical check on the market. Mitesh, morning. Mid-caps are going strong. Do you want to take us through your view on the market so far and your top bets?
So it's the breadth, which is exciting today, you're right. And I think that's where the focus is. Both the indices, the structure is positive. So maintain your long positions, but the trading now should be focused upon the mid-cap size. So I have a buy on Coromandel fertilizers, and a lot of fertilizer stocks are buzzing today. So Coromandel is a buy with a stop below levels of 1145. And look for a target of around 1180 to begin with. And the other one is a buy on NMDC, which was a buy earlier as well, but now can be bought afresh with a stop at 234 for targets of 250.
Okay, Mitesh, got that. Thank you very much for all your trading calls. We have a bunch of telecom stocks that are actually in news today, starting with Bharti Airtel. But the ones that are more interesting, at least for me, are calls that have come in on Vodafone Idea as well as Indus Towers. And on both of them, the broker notes are a little sort of raising a bit of a red flag and even questioning whether Indus has run its course in terms of the huge move, the rally that this stock has seen. So, Rima, over to you.
Well, on all the three telecom names, there is a note today. So let me start with Bharti Airtel, where Antique says that the company is set to ride its best financial performance phase in a decade. Okay, so which is why they've initiated coverage with a buy call, target price 1500, so about a 20-25% upside from current levels. What's driving this? Tariff hikes, upgradation of 2G subscribers to 4G, strong growth in their enterprise business, FTTH, and also a decline in capex. The company has, like Reliance Jio, Bharti Airtel, they've both front-loaded. They've completed their pan-India 5G rollout. So capex is going to come down. Capex was high because of 4G and then 5G over the last few years. But now it's done. 6G is not coming anytime soon. So capex will come down, which means more money in the hands of Bharti Airtel. Return ratios will go out and the company will be able to delever their balance sheet. In fact, I'm not the Antique note, but there are many who believe that the company will even give you a dividend because of the amount of free cash flow that they will be generating. Vodafone Idea is a sell call. The company has seen a loss of 17 million subscribers in the last 12 months, and this is because the company has not been able to invest in its network. Its capex is very low compared to peers. It stands at just 1,300 crore in the first 9 months, and the street is still awaiting the 5G rollout and the external fundraise. So sell call on Vodafone Idea, target price at 5 rupees. And the last one is Indus Towers, where Jefferies believes that after the 60% up move on a year-to-date basis, the stock is pricing in all the good news. The potential good news is that Vodafone emerges stronger. Vodafone starts spending more as it starts its 5G rollout, which will benefit Indus Towers. But according to Jefferies, with the kind of up move that we've seen, a 60% on a year-to-date basis, all the good news perhaps is priced in. So those were some telecom updates.
Okay, so those are the telecom stocks in focus today. We do have to take a very quick break. On that, actually, I think we still have Mitesh, so I just want to toss this across to him. If there's a trade on any of the three, let's start with Bharti. That's on the fundamental side, that's a big target, 1500, that the brokerage note put out. Mitesh?
See, I think, this stock, I'm not sure whether we are heading towards 1500 immediately because difficult to give a target on a stock which has been making higher highs and higher lows. But the good thing is that as long as 1165 holds, we should look at least a break beyond 1240, which was the weekly pivot. And once that happens, I think 1320 becomes the next logical target. So stay positive over here. Vodafone is something, which did a good rally a few weeks back. And, since then, you've seen the stock kind of go into some kind of a mild correction and a pullback. And the charts here are not positive. So I'll avoid that very clearly.
Okay, all right, got that, Mitesh. Thank you very much for all the trades today and all the advice. We will touch base with you again in the afternoon. Right now, we do have to take a break. On the other side, a lot of other buzzing stocks that are moving because of either news or more brokerage commentary. Will get you the latest. Welcome back. Well, it's a strong mid-cap market for sure. So let's talk about some of the stocks that are in focus. Kolte Patil is surging 8 to 9%. That's because Motilal Oswal has started coverage on the note. So we'll talk about that as we go along. Vedanta is reacting very favorably to a CLSA note. CLSA thinks there's further upside possible in Vedanta, and that it's a good play on this whole move that we're seeing in commodities on the metal side. This is something that even Nigel has been alerting us about. And MCX once again is reacting to brokerage notes. There's Protean e-governance, which is on our radar as well. There was a large trade in Protean e-governance. The market buzz is, what sources seem to be indicating is that 361 has sold off quite a bit of its stake today in Protean. So lots of stocks that are moving on news. Well, let's see. I mean, if we can, in fact, start with some of these. Yeah, I do think we have Hormas with us. So starting with Vedanta. Okay, we have everybody now. Okay, guys, thanks for joining in. Hormas, let's start with Vedanta. I think the market's really taking note of that CLSA call.
As Mangalam was mentioning, right, if there is one music that the market would want to listen to is heavy metal, and that is what Vedanta is reacting to in today's trading session as well. And CLSA, while upgrading Vedanta to a buy from its earlier rating of underperform, is saying that Vedanta is well placed to benefit from this ongoing commodity upcycle, considering the fact that it has a very diversified business. And as you know, that Vedanta has its businesses across copper, zinc, aluminum, and all of these prices have been rallying over the last 10 to 15 days in the global markets, and that is showing up in the stock price as well. Now, what they also say is that Vedanta's efforts to raise capacity and profitability across segments will augur well for the company going forward, and as a result of which they are raising their EBITDA estimates by 4 to 13% over FY 24 to 26 on higher commodity prices and a lower cash cost assumption going forward. Some of the key things to watch out for, they say that the demerger that the company is currently undertaking, they were planning to complete it by December of 2024, but it is still ongoing. They plan to split the business into 6 different entities. That will be one thing to watch out for. And the other one is the transfer of the Konkola mine from Africa to the company. That will be another key corporate trigger to watch out for, according to CLSA. And now, as at current prices, Vedanta is trading at around 5.4 times FY26 EV to EBITDA compared to an historical average of 7 times, which gives further re-rating potential according to CLSA for the stock, and as a result of which they have upgraded the stock to a buy. They've also raised their price target. It's a 50% hike in its price target to 390 from 260 rupees. The stock up and about in today's trading session at a 2-year high as we speak.
7% up today at a 2-year high and 33% up this month. The rally, the juggernaut just continues. But now let's move on to talk about Kolte Patil. Sonal is joining in. Sonal, it's the Motilal Oswal note.
Yes, they've initiated coverage on Kolte Patil. Real estate stocks, they have been flavor of the week already, and now there's an addition here. They call it a leading real estate player in the geography of Pune, or the region of Pune, and they've been expanding as well in the Mumbai region and Bengaluru as well, which is a high growth market according to Motilal Oswal. They have 43 million square feet of pipeline in various stages of development. The company has seen 36% CAGR when it comes to pre-sales between FY21 and FY23, and going forward the expectation is that the CAGR could be around 25% in the medium term. The future growth is underpinned by profitability and cash flows as well, so the balance sheet is also strong, not only the P&L or the operational side of the business. They are targeting project additions over the next 6 to 9 months, and that is something which will lead to a growth of 30 to 35% in terms of their pre-sales and volumes as well. They have a target price of 700 rupees on the share. They have initiated the coverage with a buy rating and quite bullish on this space.
All right, got that. Thanks very much, Sonal. Well, with that, let's head to Vamakshi and talk about MCX, which is also up and about. It's reacting to a note. I think this is also from Motilal Oswal, Vamakshi.
Well, absolutely should be. MCX is a buzz on the back of that brokerage note that came in from Motilal Oswal. They've gone ahead and upgraded the stock from neutral to buy, given a target price of 4,300 rupees per share. Largely what they're highlighting is that new products and variations in the existing ones will be key drivers for the company. They launched steel TMT bar contracts, which could be a good volume generator over the medium term. They've applied for power future contracts, and they see huge potential here as well. And they also plan to launch mini contracts on other metal products, which will again enable the company to boost its volumes. Regulatory measures like interoperability of margins, rectification of difference in calculation of margins between the equity and commodity markets may help the company to boost their volumes further. Apart from that, they also highlight that retail participation has significant headroom for growth, and they say this because MCX currently has around 1.4 million UCCs as compared to nearly 40 million active clients on the NSE. Apart from that, we all know that the company has struggled over the last few years, given its transition in the core operating software from 63 Moons to TCS. And after the transition has been completed, they've noted a significant jump as far as the volumes are concerned. Overall, they're expecting a 47% CAGR in option volumes from FY24 to 26. They expect the company to have to post an EBITDA CAGR of almost 205% and a PAT CAGR of almost 157% over the same period. So largely, the tech overhang behind the near-term potential drivers in place, and therefore they see meaningful upside potential in this counter.
Thank you very much for that. We'll get into a break. On the other side, we'll get chatting with the management of UCO Bank to discuss their business outlook. Stay tuned. Welcome back. Let's get a corporate conversation going now on Trading Hour. UCO Bank is in focus following its fourth quarter business update. The bank has reported a 5.6% growth in deposits on an annual basis, while the credit to deposit ratio has improved to 74.8%, which compares with 67% same time last year. To talk about the way forward, we have Ashwini Kumar, Managing Director and CEO of UCO Bank, joining us on the show now. Thank you very much, sir, for joining in. This is Rima here. If you could give us an indication of your deposit growth, it does appear slightly on the weaker side compared to what some of your peers have reported. Is this a cautious stance taken by the bank given where your CD ratio was? And what's the outlook on deposit growth? Would you be more aggressive in mobilizing deposits going forward in FY25?
Thank you for having me on the show. And you are right that was a conscious call by the bank. Because our CD ratio was lower. It was hovering around 64% earlier last financial year. And now our intention was to increase our CD ratio, and we have excess SLR securities, and we have disposed of certain securities, and liquidity has been used therein. And top of that, we were using that under the TAPS market also to raise funds from the local market. So that was a conscious call. We did not raise any CD also, and we did not go for the high cost deposits during last year. And our main focus continue to remain on CASA, and going forward also, our focus will be on CASA and for improving our CD ratio. And looking at the current economic environment and the liquidity in the market, deposit rates have slightly come down. And now bank has started a little bit of focus on the deposit front as well. And we expect the deposit also to grow. And once we reach to around 74 to 75% of CD ratio, then we will take a call to go aggressively or to not.
Okay, sir, thank you. You answered the immediate question that was on my mind, that what is the targeted CD ratio? So you're saying you'll go up to 75. And then take a call. Talking about deposits, I mean, the growth has been quite healthy. Year on year, domestic deposits are up about 3.7%. Your CASA ratio right now stands at just below the 40% mark. Now, is that a comfortable zone for you? Would you like to increase it from here on as well? How comfortable are you with respect to the deposit position? And then CD ratio, will you keep it to below 75% and not go above that?
See, if you talk about CASA, historically, if you look at our numbers on a quarter-to-quarter basis, our CASA ratio was around 37 to 38% hovering around. This is the quarter where we have touched 39% CASA ratio. And our endeavor will be that on a sustainable basis, we should increase our CASA ratio, and we should cross 40% in this financial year, current financial year. That is on the CASA front. Second, on account of your CD ratio, I have already spoken that our intention is to reach first 75%, and that is also a number we need to achieve, because historically, again, if we look at our CD ratio, it was around 64, 65, and if you talk about somewhere 2 years back, it was around 59% only. So slowly and slowly, bank is inching and improving its CD ratio. And it will help not only in net interest income, but also to improve our margins going forward and operating profit as well.
Okay, so since you're talking about reaching 75% on CD ratio, let me turn the conversation to growth in the book. Growth in advances is very, very healthy, above 15% year on year at the end of the fourth quarter. Even sequentially, the growth is 4.5%. So just give us some more perspective on where the loan growth is coming in from, which are going to be the big focus segments for you as we step into, when we look at the first quarter of the new fiscal and beyond.
See, if you look at our loan growth composition, the mix, our RAM, retail, agri, MSME mix is around 61%. And we are continuously increasing, proportionate increase in all our segments. When we talk about around 16% increase in our credit growth during this financial year, our retail, agri, MSME all have grown reasonably in the similar lines, as well as the corporate credit growth. Previously, in earlier years, our corporate credit growth was not healthy, and we were lacking in the corporate credit. This year, our corporate credit. If you talk about the demand is coming from around all the sectors, maybe steel, maybe textile, maybe energy, and maybe when we talk about retail, particularly home loan segment and car loan segment has also grown very well. And going forward, when we look at the economic environment, high frequency indicators as discussed by our honorable governors are also during the RBI MPC meeting, all economic indicators are showing a robust growth, and we expect the growth momentum to continue, and the bank will continue to strive to achieve the credit growth as well as we have done in the past.
What's the loan growth that you're targeting, sir, in FY25? And if you could break that up in corporate and retail?
See, our guidance for the previous year was around 12%, and we have achieved around 16%. And when we talk about 16%, it is in similar proportion on all the segments: retail, agri, MSME, and corporate. And going forward, also our guidance will be around 12 to continue the same guidance of 12%, and with the same proportion, 61 to 62% our RAM, and around 39% should be our corporate credit, and the similar growth percentage should be across all the segments.
Any risk cropping up on the asset quality on the horizon?
See, if you look at our slippage ratio, last year our slippage ratio was 1.75% on a yearly basis, and this year we had given a guidance of 1.25%. Till December, we are within the guidance, and I expect that when the audited numbers are out, so we expect to maintain our guidance that our slippages should be in this range only, whatever guidance we have given. And going forward also, when we look at our SMA book, as you can see our December results earlier, since March is under audit, we will be able to declare March SMA levels and stress levels once the audit is over. But our SMA percentage has been consistently coming down on a quarter-on-quarter basis. And similar trend I expect to continue in this quarter and going forward also. And similarly, the slippage ratio, which is hovering around 1.25 now, we expect that we will, once the numbers are out, we will be able to give you the guidance for the next year as well.
Okay. No, fair enough. I know we can't get into too many specifics, sir, that we'll do at the end of the fourth quarter numbers declaration. But just in terms of directionally, since we're talking asset quality, will FY25 be a year of big recoveries? I mean, from the NCLT, or, just directionally, what's the asset quality trend and recovery trend for FY25?
See, asset quality, if you have to see on a quarter-on-quarter basis, if I talk about my bank, our gross NPA ratio was 4.72% when we started our year 2023-24. We had given a guidance of 4% that will come down to. In December itself, we have breached that level. We are 3.85. And we expect that this quarter, our gross NPA will come down further. Similarly, net NPA also has come down from 1.29 to 1.85 in the previous 0.98 in this December quarter, and expected that it will come down. The same trajectory is expected to continue. If we talk about NCLT and big recoveries, I think big recoveries in NCLT will not be there because all low-hanging fruits have been encashed earlier years and last year. There are few big accounts which can be resolved in next year, and our recoveries will be mainly from other than the NCLT also, where we have a TWO portfolio, we have gross NPA on our book. So effort will be for the upgradation of last year's slippages and also from the TWO book which we have already created.
Thank you very much. Look forward to chatting with you once your Q4 numbers come out. That's UCO Bank for you. Staying with the banking space, Abhishek is now joining in to get us a quick preview of how banks fared in FY24. This is a part of our special offering, FinStreet.
Well, in FY23, banks saw record net interest margin, lowest credit costs and best ever return ratios. Records gallored in FY24 for banks with respect to the business momentum, that is deposits and advances growth. Now, deposits crossed the rupees 200 lakh crore mark in this fiscal. Deposit growth in FY24 has been one of the highest that you are seeing in last 7-8 years or even more. There is no debt to deposits. It's actually the fast pace of loan growth which has meant that the incremental deposit requirement is pretty much on the higher side. X of SDFC Limited, deposit growth for the banking sector was 12.9% YOY in FY24, one of the highest that you are seeing in last 8 years. With SDFC Limited numbers, deposit growth has been around 13.5% in FY24 on a YOY basis. That is one of the best in last 10 years. Now, loan growth has been robust as well. Even without SDFC Limited number, growth has been on the healthier side. Loan growth for the banking sector has been one of the highest that you are seeing in last 12 years without SDFC Limited numbers, and 13-year high with respect to the loan growth on a YOY basis even with SDFC Limited numbers. So loan growth for the banking sector was at 20.1% YOY with SDFC Limited numbers. This is the best that you are seeing after 21.55% YOY record that you saw for the banking sector in FY11. X of SDFC Limited, the loan growth was a 16.24% YOY in FY24. That is the highest that you are seeing after 17.1% YOY growth that the sector recorded in FY12. So credit to deposit ratio of the banking sector touched 80% for the first time ever. Now, credit deposit ratio has been on the higher side as loan growth has been massive in last 2 years. In fact, the last time system deposit growth outpaced the loan growth was for the fortnight ending 8th of April 2022. Even if you exclude SDFC Limited's numbers, the credit to deposit ratio of the sector is the highest that you are seeing in last 12 years. So CD ratio or credit deposit ratio X of SDFC Limited is at 78.09% in FY24. Now, this is the second highest CD ratio in last 13 years. CD ratio was at 78.1% in FY12. So entire fiscal year, M3 growth has largely been in double digits between 10% to 12.5%. So first time around in 3 years that you are seeing double-digit growth for M3 entire year. Deposit to M3 ratio has been one of the highest in recent times, at least in last 5 to 6 years or even more. So in terms of outlook, credit growth may come down if banks focus more on deposit growth in order to reduce their credit deposit ratio to RBI's requisite levels. Banks say July or August will be litmus test for the banking sector with respect to deposit flows into the system. Deposit growth may continue to come in at elevated cost for the banks till H1 of FY25. Banks say deposit and advances will see double-digit growth in FY25 as well.
Thank you very much for that. And we have an announcement to share with all of you as we get into this break. We're launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate Personal Finance Handbook with Sonia Shenoy. She will be joined by 3 well-known experts on Saturday, 11th of May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth. Be it insurance, tax saving, managing your portfolio, retirement planning. There's lots to learn, lots to do. Whether you're in your 20s, 30s or even 40s, this live webinar is for you. We have limited seats, so don't miss your chance. Register now. Scan the QR code to register or log on to cnbctv18.com and we'll see you on the 11th of May.
Welcome Welcome back. Markets retaining, well, the bulk of its gain, 50 points on the Nifty. Midcap's doing really well. We did catch up with Gautam Duggar of Motilal Oswal today to figure out whether the earnings picture will continue looking as solid as it has over the last couple of quarters. And he says yes. The expectation is about 6% earnings growth for Q4, but 15% earnings growth once again for FY25. Take a look and also hear out some of the top themes that Gautam likes.
The first 9 months earnings growth in Nifty was 26%. And we had expected sub 10% kind of a growth in fourth quarter because we had done the 4-quarter split right at the beginning of April, as we always do last year. So this quarter, 6% growth, therefore looks a bit softer. Next year, we are expecting about 14-15% kind of an earnings growth number. I would say, quarterly fluctuations aside, the earnings momentum for corporate India is very solid. And like we have mentioned in our report, it almost feels like a mini Goldilocks because macros are fine, earnings growth is fine. So yes, this quarter is a bit soft because of commodity, but otherwise the trend is quite intact. There is a requirement of 2-3 things to happen. Number one, the monsoon needs to be normal, which is a good thing because there is a prediction that this year's monsoon is going to be normal. Point number two, inflation needs to come down, which is also happening, by the way. So inflation prints are coming off. And third, it is a hope that the political spending in the forthcoming elections, which at some point of time with a lag of 6-7 months, will propel consumption at the bottom of the pyramid. Hardly 1 or 2 consumer staple companies have been able to compound their top lines at 10%. Most others have compounded at 6-7% top line growth. I'm not even talking about earnings. So top line has been very, very lackluster for almost a decade now. So that's a hope. But from our point of view, we are still very as far as our model portfolio is concerned, we are completely positioned towards discretionary consumption. There is some element of, as I said, optical illusion built into it. And there is also a fond hope that the global economy will show some recovery, especially China. Because when you talk about metals, obviously the big elephant in the room is always China. So that is our expectation that there will be some recovery in metals profitability, and which is why we've raised allocation on metals in our model portfolio from being underweight for last almost 9 months to now being neutral.